Welcome to the new Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. And we're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Millikan's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Welcome to episode 15 of the New Barbarians podcast. Today is Monday, April 7th. The podcast will hit platforms later today. Last week's widely quoted two-day S&P loss of 9.9% is actually a two-day compounded loss of 11.06%. Our podcast just shared a LinkedIn post, so credit to Sean Russo of Ritholtz Wealth Management. There have been three instances worse than what we just experienced over the past 2 days in 75 years of data. October 1987, otherwise known as Black Monday, November 2008, when Congress rejected the global financial crisis bailouts, March 2020, when COVID was declared a pandemic by the World Health Organization. His boss, Josh Brown, recirculated the note with the comment, "This time, unlike 87, 08, 20, the stock market crash is literally the work of a single person, truly a remarkable moment in history."
We can just put a pin in it right there, Bill, because I think that point is absolutely the focus for our call, as we talked about, because it's about how tariffs, something that really haven't been talked about except 1930 Smoot-Hawley, as we talked about in the Substack and was popularized again in the Ferris Bueller quote that's been circulating around about anyone Bueller, anyone tariffs. How did Smoot-Hawley work? Did it help? No, it didn't. It put us further into a depression in 1930. And then Trump again in 2018, 17 and 18, which then led to the Powell pivot. So I think and today we're going to make this a tight show because everyone's going to be staring at the tape. We're going to talk about how the discussion of April 2nd, which is Wednesday afternoon, just 2 days of trading. We haven't even opened in New York yet, in the U.S. So we're talking about 2 days, Thursday and Friday. The fact that I think we want to leave our listeners with, this is still being digested. There's not a consensus. Some people say, oh, you got to take Trump at his word now. Others are saying, no, it's a negotiating tactic. There's no consensus, but what there's clearly, I think, if I want to point to one part that cannot be unrung, a bell, is Germany's need to fund itself, which is inflationary, fiscal requirement to do another $1 or $1.5 trillion of funding as Trump pulls back from NATO. So this is not a negotiating tactic. We're going to go through some numbers quickly, and then, Bill, we want to go back to you to sort of run through some quantitative analysis, as well as, is this just another day? And I'll ask you right now, is this just another day at AQR or 2 Sigma where people are just sipping their coffee saying, oh, the data shows something new? Interesting. Sally, did you see that?
I don't think that this is a normal day anywhere, including places where people usually just wear headphones and don't watch the market all day. And as a former risk manager at a quant fund, one of our concerns often was maybe, the researchers aren't watching what's happening in the market. They may not know exactly what's going on in their portfolios, but no one can ignore this. Usually quants will have some portfolios performing well when others are not. And, you typically, aren't going to suffer the same way that, people who are long multiple markets. Of course, risk parity portfolios, everything's suffering right now. I think there really is
Yeah.
no place left to hide. And then just to finish, the thought about that being 2 days, over the weekend we had sell-offs in crypto, and Bitcoin, suffered yesterday. Nikkei is down 7.8%. Hang Seng was down 13. And then S&P futures and NASDAQ are, pushing negative 3% today. So, one question people are asking is, are we headed to a depression? Which seems to be the big concern whenever we're in a market environment like this. Personally, I felt like the global financial crisis was worse, um, because you basically did have the same exact setup that the Great Depression had. Banks failing, bank runs. Um, but this is pretty crazy. Like the global financial order has been disrupted at least. And yeah, I guess I can get into more quantitative measures of how bad things are, but yeah, they're very bad, very statistically significant, and these things aren't supposed to happen even in 75 years. This is
Yeah. So I want you to come back to those quant figures. When you were talking about '08, I agree. I had the feeling, I think it's because we were closer to the financial crisis. I had a hedge fund. We were, in '05, we were, aware of the debt load, short Fannie and Freddie, long CDS, short credit, which by the way didn't work out because the equity failed, but the credit didn't. So it, '08 was a financial dynamic, and it's relevant to this because the reason it didn't lead to what our bellies were telling us, which was something more than a recession, maybe not a depression, but an abject failure, and the bank's ATMs don't work. The reason that didn't happen is because from on high, federal government said, I got you. And then they absorbed the debt, and they were no longer 70, 80% debt to GDP, but 105. And then COVID kicked them to 125. And now, as the Ritholtz guy said, as you said, there's another agent that came in and said, you know what? Let me rip another hole in the world order. Not financial '08, not pandemic like 20, but let me do something on trade. And I'll put it there, I'm not going to speak for you, but I don't have as much background or data to examine, even though we've done the work about how trade is, almost 10 times larger than the net number, that it's impactful. I don't know what that means. I don't have enough familiarity or workings with shutting trade channels down other than to say it's kind of like COVID, where if the velocity of transactions stop, the economy stalls, and people don't have savings, my friend.
no,
I don't think
no,
to deal with
and
this.
I don't want to. Well, it's too late. I am alarmist at this point. Everyone is, and so when was the last time we saw tariffs, especially like this, the 1930s? That was the Great Depression. Um, and I think to really further the thought, why did I did remember history. You learned about the bank failures and the runs on the bank and people getting in line, um, and that's what the history books told us. But what the real risk at the time was, there would be no more um, capital markets available to corporations. And so you think about the S&P 500 and the stock market and all of the public companies who borrow money, um, would no longer have access to capital, and that is what would cause the Great Depression. Um,
Yeah, yeah,
and so the government stepped in and played the role of the banking system, and it arguably still is playing that role, 17 years, going on 17 years later. um, but I think another thing that you and I realized as we were preparing for this talk is, whatever market you're in, you need to have a better value proposition. And, you know,
I
I
know.
think
Yep.
that you and I are now using AI and lots of technology tools. I think we're arguably producing more as teams of one and three versus 17 years ago. We had teams of people that were just doing sections of what we are now accomplishing on our own. And I get back to data and AI and quant research often. Obviously, like right now we don't have a lot of historical data that's going to help us predict what's happening next. um, and
Yes,
so
right.
we have to be creative, and I think that's where AI, disruptive tech, keeping an eye on all of the players is going to be the only way to really weather the storm.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
And and let's just talk our experiences. You and I are singletons. We've tied our boat together for the podcast. We're doing now business together. We're meeting clients and offering our expense reduction, revenue expansion proposition. Excellent. But there's proof in the pudding. Your LLM piece in December is the best that I've seen. As I showed it to people, no one has seen the clarity and the distinction of the models and what they present, as well as their blind spots. So if you're hiring someone, you put them through a rigor of examination, and that's what you've done. You've hired a few models and you've done it. And that December piece, again, I know you've updated it and you joke about it's almost like an adolescent turning to a teenager or prepubescent. It's like these things are really evolving fast, and you have to understand their personality. So that's one. And the second point is, and I'll again, at a point in time, you have to recognize what value you bring. Working with you and incorporating these in my process has allowed me to, I think, get ahead of the curve. On April 2nd, while the market was going up, I posted my Substack about this is not in the data, folks, and we gave reasons why, because of the ability to pull forward ideas that are not yet expressed in the data. I sent your LLMs on a mission, and they came back and they said, Mark, this 8.1% quarterly return in NASDAQ, again, this is April 2nd, so we're only days into this resolution. This hasn't happened that often, and we published how, besides recessions, the only other times it happened was Greece failure, which led to the European printing of money, as eventually Draghi's whatever it takes moment years later, and the other one was Trump tariffs. It is like the visitation of tariffs on markets invite this, and by using your LLMs, it helped me contextualize it. While the market was still going up ahead of that Rose Garden debacle. And if it's okay, I want to just go through some slides, because I think we need to see things. We hear a jumble of information, but let me just show a couple things on our screen, and then I'm going to go back and have you show some of those quantitative approaches that you talked about.
And while you pull that up, I did want to just respond a little bit to the vigilance that's required with LLMs. Yesterday, I asked it a question, and its response was, I incorrectly fabricated organization names like JP Morgan, Goldman Sachs, BlackRock, Two Sigma, and AQR. And I'm always very appreciative of its honesty. But like if your first year analyst came back and said, "Oh, I'm sorry, I incorrectly fabricated the answer to your question," I think that they would get fired. But part of me would always appreciate their honesty. So, I think that it is a buyer beware type of tool. And I get a kick out of these things, and that's why I try to share my social media posts with these crazy answers that you get from a computer that's hallucinating on drugs.
Yeah, and I've gotten some too, which is again why, pulling the source data that they provide is still imperative. So and that's where a culture of a firm or experience, hopefully, that we bring shows you, because we were always first principles based in our research. So this is just a tool that we incorporate. But maybe some of the people who haven't had experience working with 10 Qs and pulling them down and waiting for them to hit on Edgar have to, may take things at face value, which is going to be, again, all the more reason, even though there's more information, Bill, and why we're doing this podcast, is to say we've scrubbed the data, we've made a list, we checked it twice, and we can tell you which markets are naughty and nice. Now, building on that fun Santa Claus, ain't no Santa Claus rally here. On that moment, let's go back to the data. This posted on April 2nd on our Substack, on my Substack, was still something, again, that I like showing outlier moves. We don't show every day's returns. We show returns that are 8.1% or lower. So you see Q1. There you go. But then you see, but then you see other returns here, monthly returns that are 8.1% or lower. I went to monthly. And what you're going to see are 2022, when the Fed pulled the punch bowl away and just broke banks in half. Then you see COVID. Then you see two periods in 2018. Those are the Trump tariffs. To let you know how impactful tariffs are, they're impactful like a once in 100 years contagion.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
So this is what we shared on the April 2nd slide, while the markets in our Substack still open, using the LLMs that Bill has weaned me into or onto. And the idea here is, we took 25 years of data and said, only show me the declines of 8.1% or more on a monthly basis. I chose monthly, even though it was a 8.1% quarterly return for NASDAQ. And if you look at it, you'll see 22, of course, when Fed went up by 500 basis points, broke banks, and caused like Liz Truss to lose her PM ship in 44 days, the quickest. It just roiled currency markets. They had to create new programs, like Bill said, and they did in 08, the BTFP. So the Fed had come in. They were the arsonist and they were the firefighter. Then that 10.1% is COVID. We know what that is. But the Fed acted quickly and staunched the bleeding. So it was only a brief moment in time. But look at the next two. Tariffs. Back to your point, Bill, about one man wreaking havoc. These are Trump tariffs in 18 that eventually led to the Powell pivot famously on January 3rd of 19. So, you have guys like Bob Michel from JP Morgan saying the Fed may pivot before May. Of course they are, but if this continues, I mean, that's a low bar. And the rest of the days, obviously, 8.3 was when Greece was basically about to blow up on a credit basis, and the ECB had to come in. So, and then 08, and then you have obviously the
I'm sorry
bubble.
to go back to the tech bubble there, but that looks more like reality to me, where it happens repeatedly over an extended period of time. It's a recession. That's what I think we grew up with, and then since the credit crisis, markets don't have prolonged negative sell-offs. Like even just looking at 08
No.
versus the tech bubble, it doesn't look that bad.
Yeah. It's still hard not to think that Trump is doing a controlled tackle of the market here to try to bring multiples lower, to try to bring the interest rate lower. As we know, we keep saying there's 6.5 trillion of T-bills, plus almost 3 trillion of notes and bonds, plus probably another 2 trillion to 2.5 trillion of new debt from deficit spending, all done this year, that they need lower rates. So what this means likely is that from an economic standpoint, if companies' margins are going to be compromised by tariffs, or people have to pay more, Bill, back to our two themes, define the global macro environment and put it in context. It's meaningful and it's not over, so check that box. But back to you on the quant side and tools. How does this market where nominal returns may not be as high? Let's just say it. There's no way that firms are not going to be integrating LLMs into their process. So maybe give the audience a heads up on like one or two things that either players that are already doing it, models that are working better for quant research in markets versus others, just to give them a little taste.
Well, it's a timely topic for me because I'm personally going back through all of the academic and practitioner quant research I can find to try and identify models that are good in this environment. And the things that come to mind are like Nassim Taleb and Black Swan types of models, which I think are notoriously underperforming, for long periods of time, and then they do really well in truly crazy periods of time. And part of the reason I don't like those models anymore is because, again, they're kind of trained on history, and we've been in this permanent regime shift now for 17 years where the true crash is not allowed to happen. So, crash options are very valuable when there's a true crash. But when the Fed comes in and stops things before they get too crazy, you don't get that huge payoff. And I believe, diversification is always the answer. You want to stay invested. I don't really love being long risk parity portfolios. I read a note that macro futures portfolios are getting low to ground, and so I think we're going to see more of a momentum sell-off. So maybe that's the answer. I think this is when you really want to own a managed futures allocation because they're going to be making more money as things get crazier and momentum gets worse to the downside. Having said that, that can also exacerbate the overall market's performance. So, I think if you were to look at the right thing to invest in this environment, it probably would be managed futures, quantitative portfolios. And I believe now there are certainly mutual funds, but I think there are going to be ETFs that give you that exposure.
Yeah.
And I don't
Yep.
know if that's a good or bad thing, again, because you're going to have, more liquid access to these strategies that I think do exacerbate downturns and presumably also overinvest when things are getting hot and going up. But yeah, so that's, I think your multi-strategy, quantitative, diversified bet is the only way I get comfortable, and you have to sort of hide your head for a little while and stay invested because things will turn around. I'm not going to predict when. I think over the last even couple podcasts, I was like, oh, it seems like maybe we're experiencing a short-term bottom, but then no one predicted that Trump's tariffs were going to be as significant as they were, or um,
I agree. Yeah, there's nothing to be remiss about that. We were the same way. We said in the podcast, let's look at August 22 and August 23. Market dumps 10 to 13%, takes a breather and says, where are we now? And the where are we now moment was no reversal. It was a engagement like as our data showed, 1987, 2008, COVID, and today. So before we close up shop, I want to just say one thing, how fast the market's moving. We tooted the horn of Bitcoin over the weekend saying, hey, month to date, Bitcoin's up 2.2%, markets are down 9. That's 1,100 basis points of outperformance. Bitcoin, and it still is impressive that Bitcoin did that. Bitcoin's now down about 8% from that moment. Markets, it's still outperforming on the month and the year and the 1 year, but it's collapsing. So for someone whose mandate is to speak to investors about incorporating a little bit of Bitcoin in their portfolio and the diversification benefit, nothing's changed, folks. It's not that I'm doubling down on the idea. It's in the data. Bitcoin should be down 40% month to date based on what people think it does, which is 3 times the movement of NASDAQ. It's not. It's actually performing better. So we'll keep you up. There are other ways, there are safe ways to incorporate it, but really the gist here is to share what we thought the scope and scale of the sell-off is. Not done. Tariffs are longer running, leave scars that can't be really reversed right away. And the second point is what Bill was saying about the incorporation. Fund managers are having a tough time making money. They're going to have to lower fees. And I think that's, not to put words in your mouth, Bill, but that's why people are, darkening your doorstep, is to figure out ways to reduce expenses and add more utility.
I think that's correct, and we'll see how hedge funds do in this market. The whole value proposition of hedge funds has been, problematic now in this, again, a new regime with the Fed backstopping assets and with the market perpetually going up. I think it's been a difficult time for hedge funds to prove that they'll make money in a down market. And I know in my PA, in my personal account, I finally threw in the towel and I was like, okay, I'm just going to be long. I'm going to be into riskier assets. And, given my age, that's not such a great idea. But if hedge funds can prove that they make a lot of money last week, for example, because they're prepared for such an environment, great. I think people will pay up for that because that was the idea. I sort of doubt that will be the case, and that's been proven, multiple times over downturns. And I do think that it's just a difficult value proposition. You trail the 25, 2 years in a row, 20+% return of passive assets, just
Massive, yeah.
and then
And Bill, there are fewer people who can do it, as you know. I mean, you've been in a few funds that are still around, and a lot of them aren't. And as the Fed continues to absorb and central banks expand balance sheets, they dampen volatility and asset distinction. So that it's like a Hunger Games, one client used to call it when I was at Credit Suisse, where they're just eating each other's alpha, and it's a zero-sum game, and there's not a lot left.
I agree. So I think it is a worthwhile discussion to even talk about 2 and 20 and some of the fees that are out there for long short equity funds. Like I said, we'll see how they're doing. I think we're probably not going to see a lot of good performance. And even in quant space where you have emotion taken out and you sort of build a portfolio that should be resilient, it is still based on historical data and historical relationships of the way people invest, and no one can predict what's going to happen today. I mean, it looks like we'll be down again today. That was my expectation.
Yep.
But I don't think anyone can predict when the Fed is actually going to come in. They weren't happy with what the Fed said on Friday. We'll see, day by day this week. And then eventually, I remember in 2008 when, Paulson was having press conferences, and then Congress was, having debates every day, and everyone was just keeping an eye on votes in Congress, like when is this bailout going to happen, and how bad is the government going to allow this to become, and it was all political. So I think it is just a matter of time, and obviously that will be, Trump and Besant's preference that the Fed comes in and backstops everything again, but I don't think anyone can predict exactly when that happens.
So let's go stat for stat, and then we'll close up. That chart that we showed briefly about 1987 to today, and only 4 moments of double-day returns like this. What we didn't show in the background would be the debt load, or even the 08 to 02, the fact that we have less outlier moves over time, even though we have pretty meaningful issues like a once in 100-year COVID and once in 85-year or 95-year tariff regime. The reason is because in the background, what we didn't show was the debt load. And the fact that the U.S. government took like 200 years to issue 11 or 12 trillion dollars in debt, and then in 2 years, or during COVID, 4 years, it issued the same amount of money. The acceleration in debt is absorbing or backfilling and providing liquidity to absorb the loss in the markets. Banks no longer warehouse risk, and if there's a problem, the government will be the last resort, the Fed, the buyer, and that's going to continue again. So that's whatever model you have. The Fed we're at a point of no return. The government is too big to fail, not the banks now, and that's why we're not seeing those series of 12 outlier moves. And then stat for stat, I don't know if you have any quantitative measures that you wanted to share or guidance for some of our clients or folks that are listening that are in the space about how to use LLMs.
So I'll just rattle off a few statistics. Market beta factor had a 6.8 sigma move on Liberation Day. I don't actually have the statistics for the multi-day moves, but I'll gather those. This is the type of realized loss that you should see once in a lifetime. I mean, statistically, it would not even be that often, but I think what we observe is these things do actually happen way more often than they're supposed to. But it's just a massive move in a 1 day prediction of volatility. Again, I'm going back to my research, and I'm asking the LLM. Literally, I have a Gemini chat up right now that's asking it to search all of my research and all of the different signals and portfolio optimization, portfolio construction techniques that I have kept track of for, what kind of a regime could we look to apply the most cutting edge AI machine learning techniques. And I know ahead of time that the answer is going to be insufficient, but I'm doing that just to ensure that there is not something that can predict what's happening right now. As I said earlier, I think momentum to the negative side, and hopefully you have good reversal indicators. Like that would be the golden model right now. You're betting on negative momentum, and then you have a good predictor of reversal, and call the top and the bottom. But that's what everyone's been.
Yeah.
That's what every investor has wanted to do, and I can get back to having, the outcomes of sporting events, and you can bet on them, like Biff from Back to the Future Part 2. And we spoke about history class from the Ferris Bueller class. Like, I don't think there is a good history class for this one, and that's a good analogy for quantitative research. I still think it's the place to be, because you won't be emotional and you won't have these amygdala reactions.
Yeah.
But everyone's gonna have a rough week.
Everyone's going to have a rough week. LLMs are useful, but still need to be tamed, like you wrote about. And as you said, this is not in the data really, and that's why you need more support around you to throw ideas around LLMs, like you said. Well, that's I think going forward, what are we going to look at? Look at the MOVE index, folks. It hit 125, up from 90. That's the VIX of treasuries. Treasuries have not moved. The dollar hasn't moved. So this is a different type of market as far as capitulation. Any other signals to leave people between now and our next podcast to see in their head, Bill, that you think of?
No, I think we all have to stay invested. That's the primary thing, depending on where you are and how your wealth manager, or your own way of managing your retirement is set up. Like, I think it always makes sense to stay invested. This is proven to us in every sell-off. I know there are people that brag about, oh, I put my 401k into something safe right before this. Well, they'll always miss it when it comes up, right? When it bounces back. So
Yeah.
you do want to stay invested. You want to stay diversified. And you might not want to look at your statement.
Yeah. Good point. All right, with that, we'll give everyone back the rest of their day. Feel free to hit up Bill on harmonicinsights.com or harmonicinsights.com on Substack, or the macro case for Bitcoin, my Substack as well.
Thank you.
Thanks, folks.